All right, this is Gavin McGuire, event trader, and I am joined by Brett Manning, chart trader. How are you doing today, Brett?
I'm doing pretty good, Gab. How are you?
Pretty good, pretty good. Doing better than the markets, I would say, as we are just kind of watching things tick. So, that's obviously the $1 million question of where we stand right now, Brett. And hopefully, we could kind of go through these slides, talk a little bit about the market functionality, where we stand, and hopefully provide some sort of roadmap on how to treat this market over the next couple of weeks. But I suppose we could start off as we usually do, Brett, with the AAII data. This is data from Thursday, the 20th, so just about 4 days ago. And as we can see, a big pop up in bearish sentiment. The bullish sentiment was the lowest since July of 2020. So near the beginning of those pandemic levels. And it's had a pretty big decline of 1,600 basis points since the start of the year, falling all the way down to that 21 level after starting off at 37.7 on December 29th. So, Brett, when we're seeing this, obviously this is being played out into the overall broader stock market. But how do you see such a steep decline like this that we're witnessing?
Well, so first of all, just for some context, I think the main thing that's happening right now, I think you can clear everything out. The main thing that's happening is the market's going through the process of figuring out that for the first time in decades, and really sort of the first time ever, there's no Fed put on declines. And I think that's the main thing that we're watching right now. And I think that's the main thing that investors are figuring out. And it's very difficult to stay bullish in a market where I mean, the idea of there being a Fed put of there being this sort of tacit understanding between the markets and policymakers where, you know, policymakers realize the importance of stock market stability and they're going to come to the rescue when things start to get out of hand. That is something that really didn't even exist to a great extent back in the 70s and early 1980s, the last time we had inflation like this. So really, that's something that grew up over the last few decades, in any kind of really material sense. So there's been the market action has been predicated upon this tacit understanding, and now we've got 7% inflation, and that's gone. And that's, I think, the main thing that you're watching right now. And I think that that shows up in this data as people start to really process that. As soon as we get something sliding like this, and we got a Fed meeting coming right up, and what we're not going to hear at this Fed meeting is that they're reversing their position on the pivot they made a couple months ago because they can't.
Yeah, you kind of get the feeling that they are quite comfortable with this, with the price action we've seen over the last few weeks. Because one of the things that they seem to be looking to do is pricking the asset bubble here, and a way to cut off inflation. I would say, Brett, from this perspective, let's think of how many tech companies have done secondaries because it's such an easy way to raise cash, and this cash eventually works its way into the real economy, right?
Sure.
So when you're seeing price action like this, that takes away and alleviates some of the idea of wealth that's out there and perhaps reins in some of this inflation. So, like you said, I don't see them riding to the rescue come Wednesday when we're set to hear the latest out of Powell.
No, they may say some nice things, but it's not going to change where the Fed funds futures are, and that's the big difference. Right now, if at any other time over the last couple decades, this type of price action in the market would be meaningfully moving the Fed funds futures.
Yeah, we're not even seeing that budging. I got it at 85% for a March rate hike. Now,
Right.
would you be surprised if they did anything in the Wednesday meeting?
I wouldn't be shocked.
I wouldn't be shocked either. Like I wouldn't be shocked with 50 basis points too at in March
I
at
mean,
this
this is
point. If
the
they
other way
try
to
to set the table for a 50-cent pop in
right.
March, it wouldn't surprise me.
The other way to frame what the pivot that they made, and I've said this in a couple of pieces, is it's from Wall Street to Main Street.
Yeah. Yeah, where they're trying to help the saver a little bit more and rein in inflation at the same time too, you figure?
Well, asset prices aren't really a concern right now.
Yeah, even with this, I mean, we're getting close to 20% now, I suppose, in the Nasdaq, up down about 15% from the highs. The S&P itself, that's down to what, about 12, 13%. So, do you think that if it got down to 20%, that could be the threshold for okay, we need to cool off the selling a little bit, or
There's probably a number. I mean, I
yeah,
don't know. I don't know if we're there yet, though. But it's still the shift is. I think the reason why things are getting as extreme as they are today, I think, is still just waking up to the idea that there isn't a policymaker safety net. Eventually, there's going to be you know a cheap safety net, but it's really materially different than what we've seen really for decades.
right.
You'd get that Fed put, and the idea of it, just the idea of it, just people speculating, knowing that that safety net's there.
Well, it's kind of funny too, because I mean, we talk about inflation changing some of the perception that's out there, but overall rates, I was just taking a look at the 10-year, Brett, where if you take a look at that, this was just before the pandemic, up above 3%, right? And now
Sure.
we got it at 1.72%. So, it, do you think that there's an oversell going on here around fear of 4 rate hikes in 2022 or whatever it might be?
Well, I mean, probably, but the market was filled up with a lot of speculation and a
Yeah.
behavior pattern, and you always overshoot that to the downside.
All right, so let's continue on then. Uh, I know you like to look at the AAII bull ratio. Anything jumping out from this chart to you? Obviously, it's starting to get into the oversold area, if you will, popping below that green line.
Yeah, I mean, we're to the most bearish that people have been since what, July of the pandemic year. I mean, 2020, right?
Yeah,
So we're getting to deep pessimism. But again, as I always say with these charts, they're really useful, but the signals aren't in just a spike. The signals are when something festers in an area. Like if it festers down below that green line for a period of 4 or 5 weeks, that's when it's translated into uh, overly risk averse positioning that opens up an opportunity in the other direction. That's
and
when
to
you've got a tailwind.
your point, the last time we saw that festering was back around the March to August timeframe of 2020, when
Sure.
the Fed, when people were still questioning if the Fed pumping the money in was going to be the answer for all
Right.
the shutdowns that we're seeing. So,
So
uh,
that rally had legs because that's what it came out of, was people malpositioned to the risk averse side.
exactly, and that's what
It's a
we'll be.
tailwind. Yeah.
And that's what we'll be looking for. Inverse ETFs, Brett. This is one thing that was sticking out from the Trader Sentiment site for me, where we saw this hit extreme levels. And we've talked a lot about retail in the calls and stuff. Do you view inverse ETFs as a way that retail could be playing some of these downswings?
Yeah, sure. I mean, and you also see a lot of puts. But and right now, by the way, for people looking at this chart, um, if you refresh it on the site, it's well above two new highs now. It's much higher than that, but it's spiking at this point. And yeah, I mean, absolutely, it's a made to order instrument that allows people not just to hedge, but to rampantly speculate on the market continuing to go down.
Right, and not even just looking at the spikes too, Brett. I mean, the 5-day average was 20% higher than the previous peak in October. That was before today's action, like you were saying. So that's even higher here. So, people are definitely pretty bearish at an extreme level, as evident by that inverse ETFs and obviously the price action that we're seeing here in the markets too. And just kind of continuing in with the Dour Sentiment, another uh, chart that was jumping off to me from the Trader Sentiment website was Smart Dumb Money, where you could just see the participation in the rallies and the pessimism of the declines certainly fallen into bearish favor. So not a lot of surprises, but also being reflected in the higher volume that we're seeing on some of these down days.
Hmm.
Is there?
By the way, I want to go back to our last sentiment of flow show. What
Yeah.
we what we had stated is that we thought that we would see the market roll over in January.
Correct. Correct. So, just building off of that, we're certainly getting the action. One of the things, of course, was our concern going into earnings season, where you had the Omicron impact and that offsetting the performance in Q4 number one, but also impacting the Q1 outlooks, and we've seen that. So, let me ask you, Brett, the early signs, like we had J.P. Morgan obviously getting whacked pretty hard. Netflix certainly was crushed. You got any thoughts on this price action in terms of, is this setting up for for the bottom for you? Is this the initial phases of the breakdown that you want to see?
I think we're getting emotional right now. So I mean, at least some version of it, I would consider it probably to be a near-term low that's getting ready to come into place.
Okay, and again, being reflected in the sentiment.
You know,
Um,
and I'd like to see the put call much higher than it is.
yeah,
I mean, it's actually just been trickling around 120, and with the intensity of movement that we're seeing, I would really like to see it at 165, 175.
And you think that level is back to normal? Because I know we've talked a lot in the past about how the retail
Sure.
impact on call activity has kind of disrupted the read for this, but
Hey, but they
obviously
can
we
buy
got to
puts
figure
too. It could
they can buy
overshoot the other
puts too. Yeah,
directions.
yeah, no, very true. So,
They're just
uh,
playing options.
yeah, do you think that factors in that maybe you could see an even more extreme read,
I think you could
perhaps?
see an even more extreme read. Yeah, I mean, I think Wall Street bets puts calls could become a big thing.
Yeah. Okay, that'd be interesting to see how that plays out. Um, SPY Liquidity. I haven't seen a ton of people popping into SPY just yet, Brett. But I expect this to continue to march higher. You got any thoughts on the SPY Liquidity chart?
Yeah, and just the update would be it's now above that green line. But it's yeah, I mean you're gonna see right, you're gonna see it live above the green line with volatility where it is right now.
All right. Moving along, let's take a look at the Bank of America Fund Managers Survey. And some of the key points that we're looking at is number one, it wasn't overly bearish by any stretch, which obviously makes sense because we're seeing some further selling play out. Some of those fund managers that weren't bullish or that were bullish probably are losing a little faith in the or in the markets here. But some of the key themes that we're seeing in this fund manager survey included a rotation into cyclicals, which was continuing. Overall, the global reopening trumping rate hikes. Now, we'll talk a little bit about that because that's certainly in question. The hawkish Fed being the top concern. I think that remains in play.
Mhm.
CPI expectations declining, although I think we could agree that, and when we look at it, that has more to do with the year over year acceleration more so than just a rollback on CPI. Although we will talk a little bit about some of the PMI numbers we got this morning. And then commodity allocations at all time highs. Everybody looking for those areas to play in inflationary times. The bonds remaining far out of favor, and tech allocation the lowest since 2008. So they were some of the key themes, and we'll get into each one of those. But overall, was there anything that jumped out from the fund manager survey to you?
No, I mean this is all stuff we've been talking about.
All right, so let's kind of go through this and take a look. First off, the rotation, right? So we've been talking a lot about that. I know you've had your IWF, IWD charts in place, of course. Now that we're kind of stretching more into that bear market territory, these rotation slides aren't going to hold as much merit because you're going to have to see some of those winners being sold to make up for some of the losses that are
Well, now
being
it just comes
taken.
down to beta. I mean,
Yeah,
you're just the most volatile stocks are going down the
you
most.
are going
Yeah,
to
and
get hit the
most
hardest.
of the value stocks are less volatile, so it's
But
that's the
I
illusion.
I I mean, I do think it's important to kind of keep in mind what this rotation was before we started seeing some of the panicky price action going on in the markets, and just looking to see
Yeah.
where money's going. I mean, obviously, everything would probably line up with that theme of the reinflation trade, Brett, and the move higher in rates. But is there any one of these areas that's sticking out to you more than the other?
No, I mean, I think it's just we did definitely start with a real rotation from growth to value when interest rates broke out at the beginning of the year, and we've talked at length about why that happens. But um, I mean, now we're moving toward less overvalued stocks, and less volatile stocks for people who want to maintain exposure to the market, and especially at large, uh, low turnover funds.
Yeah, yeah, and I mean, so would you, if when things settle, do you see yourself going back more after the banks, the industrials, commodities, or are you kind of thinking that maybe tech finds a rebid and it just gets into that oversold condition, or you just want to see more price action play out before you're ready to make that call?
Well, I mean, as far as sectors, I'm a big believer in what's happening in energy, and I mean, I continue to sit long crude oil, and I think that's barely even taken a hit at all during this.
Yeah.
And it's just there's a special kind of perfect storm situation going on there.
Yeah, the two areas that I'm looking at that I feel you could buy on pullbacks are semiconductors and energy and financials too. Financials weren't really all that expensive, and they're getting a little baby with the bathwater. Everybody looking at J.P. Morgan, everybody looking at those expenses, but a lot of the expenses that we saw them getting hit on are something that's a little bit more manageable and can be maintained. From the semiconductor side, I just see such a long demand pathway there, and they weren't particularly outrageously valued. Certainly, they had some nice appreciations, but they were off some pretty low levels. So there's some of the areas that I'm looking at when things start settling down and looking at the broader rotation picture. But again, the next couple of slides are just going to kind of all build off that. We did have the highest allocation to late cyclicals ever. Do you have a concern with the idea that maybe a lot of people were piling into these late cyclicals and there's something more nefarious at play here on the overall broader global economy?
Say that again. I'm sorry.
So for the late cyclicals, when we get into that rotation period, they had the highest allocation ever, right? But now we're looking at the potential for a slowdown in the global economy that could build on the selling going off of which we call it off of tech that
Hmm.
we've seen aggressively getting hit here. Now, late cyclicals that would include banks, energy, and materials. Are you concerned that there could be a hiccup in the broader global economy that leads to more aggressive selling in these areas, and then really just leads to kind of an onslaught of selling not only just in tech, but some of these late cyclicals that we just discussed?
Yeah, I mean, sure, you're getting some of it already. So, I mean, if we're headed into a little bit of bear dominance for a period, and there's every reason to think that we are, it's going to be more extended than just a really bloody red week. Um, I mean, obviously that's going to impact cyclicals, but there's still there's forest and there's trees and there's individual trees like the energy sector and what's going on there.
Right.
That's a supply problem. That's not a demand problem, and we're not really seeing broad decreases in demand that are unrelated to the virus in terms of economic activity. I suppose we could see some of that, but I mean, it doesn't feel like that's the kind of situation we're in as Omicron starts to go out of the way. The other thing you have is really, I'm a firm believer in the idea that the pandemic is over.
Yeah.
Effectively, I mean, we're in a way that you almost couldn't have even hoped for. Omicron is almost this blessing that came. It's just going to shoot around the world and vaccinate everybody by force, and without leaving much in the way of real destruction. And that's huge. And that opens up probably increased demand for energy, and the supply problem is still going to be just as bad because nobody's investing in it right now.
Yeah, and I think that's one of the things I was talking with Jim about this morning is, we do have the potential for a Goldilocks, right? Where, oh,
It
oh,
comes down to China.
yeah, yeah, but we do know that China is the one central bank that is starting to pump money into the system and pumped in some more liquidity over the weekend. Now, obviously, we also got the Chinese New Year coming up, and
Well, I mean, how they handle the virus. If they try to do this zero COVID policy the whole way through, they're going to extend this wave out at the base of global supply chains for a year.
yes, I'm of the believer that they're just trying to do this in front of the
Yeah,
Olympics and the
I think so
Chinese New
too.
Year.
I think so too. And
Uh,
Hong Kong's already starting to change. So
yeah, yeah,
hopefully, I mean, they couldn't really think that they're going to keep no COVID in the face of Omicron. It's already spreading like crazy. So
yeah, yeah.
once they shift to a mitigate and manage policy regime, then it really kind of quickens the pace for getting past where there's so much pressure on the Fed.
Right, but I mean, there was also signs of they reopened a port over the weekend, right? Again, they keep lowering their rates. They lifted most of their COVID restrictions in in the Xi'an region, from what I'm looking at. The lockdown had been in place in December, so we are starting to see, like you said, them emerging with Also some loosening policies, being the only bank that's loosening out there. So I do feel confident, and again, also just to manage, the property situation. We saw a rally this morning in property stocks as they were making some progress in the Evergrande restructuring, and there was a few more asset sales from Evergrande this morning. So I don't think the China story is getting enough play here, because I think so far most of the headwinds that we've seen and comments around the supply chain have been due to negative action coming out from China. But we get China to flip around, we get Omicron all of a sudden falling off, and then people start to realize, okay, the Fed is raising rates, but only 4 times this year, and we'll be at 1%, which is still at historic lows. That does build up for a pretty good rally at some point in 2022.
Yeah. Oh no, absolutely. I mean, and we on our last strategy call, I said the same thing. There is a possibility, based on how China handles things, that this could be like a Goldilocks transition that people are going to be very much unprepared for. But it really does come down to how quickly we can take the pressure off the Fed.
Yeah, yeah, and that'll obviously be a key item. Now, would you be worried about the impact on inflation if we did see China have a big rebound?
I mean, I would think that it would reduce inflationary pressure if it also means that we're getting global
Opening
logistics
ports.
back together. Yeah, I mean, I think that the inflationary pressure that we're seeing right now is it's spread, but it hasn't. I don't think that it's. I don't think that it's completely, grassroots organic at this point. We need to reduce liquidity because that could fuel the fire. But if the global logistics situation comes together well over the next few months, certainly that's going to be the downside driver for inflation to me.
All right. All right. So, uh, continuing on with this rotation again, tech outflow, net allocation fell to the lowest level since December of 2008 in tech. Now, I would note that tech, and we'll get into this in a second, does remain the most overcrowded trade according to most of the fund manager survey participants. Where do you think we're at right now in the tech cycle, seeing some of these numbers, Brett?
In the tech cycle.
Yeah, well, in the sell-off
Oh,
cycle,
oh,
in the
I see.
sell-off of tech, sorry.
Yeah. I mean, I think that it's psychological. I don't know where to place it. It's just when the sentiment gets intense enough, when people have just thrown everything away. One stock that I've been using as a little bit of a barometer, which says we're really close, is UPST. I said to a friend a few weeks ago that I thought that it was going to hit 75, and he thought I was crazy. And I just kind of had that in my mind as one of these stocks that was such a momentum favorite. And really, if it puked below its May lows from last year, you can see a sideways range in it. That was kind of one of those markers. And I think ARC is just blood right now.
Yeah.
I mean, there's a behavioral element to this that needs to run a sort of psychological work cycle and get to where people are literally just anything to do with it. They're just trashing it at any price. All these things are going to zero. That kind of sentiment dominating some of these areas of the market that had been so, it's the sell me the story side of the market, right?
Yeah.
There's no show me the money there. It's all just what you go from seeing this golden future where everything is just castles to the sky because of these amazing new revolutionary changes and technologies, and then it changes to, oh, it's just a bunch of empty pipe dreams. That
Yeah.
tends to be what happens when technology does this. And I mean, I
Right,
don't know if
saw it
we're there, but
obviously
we're
in the
getting
internet bubble and stuff, so
we're getting pretty close to where people are just going, this is all just a bunch of pipe dreams. But there's
yeah.
still probably a little more breakage that can happen. But then, yeah, I mean, you just put on those glasses, those brown colored glasses, and throw everything away, and somewhere there's a future where those glasses are rosy again, and it's just when it's bloody enough.
Yeah, and I mean, probably nothing highlights that more than the SARK ETF, which is the, short Kathy Woods ETF, which is just on a parabolic run right now.
Yeah, right now that's
A
probably
and
what.
and unfortunately for, Miss Woods, she was the poster child for a lot of the rises going on, and now she's, getting the blame on a lot of the declines going on in that.
We talked about this a couple of episodes ago. the nature of a bull market in terms of people who are just built to buy every dip no matter what become the focus of the celebration when you get to the highs, and they also become the largest asset managers. They pull in the
Yeah.
most capital because it's been a bull market. So of course they're right every time. But when it turns, they're just so set up for disaster because that instinct is still there. It was driving all the success. It wasn't really genius. It was just an instinct to buy every dip. And it happened to be a bull market. And until it
Yeah.
turns. And when it turns, it's just, yeah, you're going to go from first to worst real fast.
Yeah, certainly been seeing that play out, and the tech outflow will be something we continue to watch from um, in the fund manager survey. Again, the bank allocation that was at its highest since October 2017. However, we've obviously seen plenty of selling going on since since earnings season kicked off. The XLF for its part, that's down about 12-13% now, busting below it's 200-day moving average today, Brett. What's your thoughts on the financials here? Is there anything that's jumping out to you on a JP Morgan or a Goldman Sachs or just overall bank allocation? Because as we know, banks should be benefiting from a raising rate environment, but do you view this as just forced selling on margin calls from people that were overweight in tech that have to sell some of the winners?
Yeah, there's that possibility. The other possibility is, something you were kind of bringing up earlier. I mean, does the risk aversion and the Fed are we already seeing the cycle start to break? I mean, I suppose that some of it's positioning and speculation of that possibility. And I don't know.
Um, for the banks, are you concerned at all? I mean, obviously they didn't reflect any sort of credit issues. That environment remains benign. Are you keeping a close eye on debt spread or anything like that, just to see if that starts changing a little, which could obviously weigh even further on this drop down? Or are you not seeing anything on on your end of the world?
Well, I mean, you were seeing some stuff. I mean, we're seeing credit spreads basically widen. Look at junk to treasuries is widening pretty fast here.
Yeah. So okay. Moving along then, commodities allocation. Even I know you are in the. Are you still involved in your USO long?
Oh yeah.
Yeah, so you get your long oil here, and obviously very bullish on energy. Now, the commodities saw their net allocation at the highest ever. Now, a lot of the times in the past, we've talked about this being a bit of an issue because if everybody's piled into this, who's left to buy? Is that something that you're thinking of right now, or do you think that we're just going to continue to see more money float into this?
I don't think that we're at an extreme yet, but I can understand if we get some hiccups because we get a little too overweight. But I think the larger issue again is such a deeply fundamental one that, and you haven't seen crazy, crazy price action really. We've seen kind of a steady grind. I mean, crude is barely above its highs from a few months ago. And again, there's just been this massive period of complete lack of investment in new supply, and it's really it ties into some of the investments we've seen in climate change related ideas, ESG investing, where there's this period we're approaching some years away where we're trying to completely transition away from it, and it's really difficult to build up a lot of production capacity in front of that kind of thing when you're talking about a sort of long-term secular thematic problem with those investments. Like eventually it's going to not be very useful. And so do you really do 5 and 10 year investment projects to develop huge new production capacity? And that's just completely dropped out of the equation at this point. And I just see this period that we're headed toward where I kind of feel I'm kind of in the camp that says we could see crude oil at $250 a barrel in 10 years because there's just going to be this problem with people making serious new major investments, and we're still
Yeah,
going to need it.
yeah, let me ask you. I mean, this is certainly in on the commodity side of things, a little off topic, but the issues with Russia and nat gas. Obviously, I know you've
Mhm.
had a couple comments about the spikes in nat
It's
gas
crazy.
prices, and a lot of this has to be around that Nord 2 pipeline that Russia created
Yeah,
with
it's a
Europe.
geopolitical asset.
Now you're pretty good at game theory. So I can't imagine. Putin wants to invade Ukraine right ahead of the Olympics, and that's going to be front and center on a lot of people's radars. But he does have a great card though with that nat gas and keeping Europe heated. Now we are getting closer to the end of winter, of course, so that power kind of wanes a little bit. What do you think's going on with Russia, and how do you see it impacting both the oil markets and overall global markets?
Yeah, I mean, I don't have a lot of thoughts there.
Okay.
I'm really not. I'm really not sure what to think about the situation.
All right. No, no, that's fair enough. But I mean, it
I can
is
tell there's a lot of stuff that I don't know.
okay.
You
No,
know what I mean?
yeah,
Yeah.
yeah, and that's important. Now, does that keep you out of dabbling in a oil company that might be steeped in that gas, or does that have any impact on your investment philosophy around commodities?
None whatsoever.
Okay, fair enough. All right. Um, bonds. Let's talk about that. We're looking at uh, the allocations, equities obviously remains pretty heavy in favor. We saw a pickup in cash, the amount of people that people put into cash. Commodities high, alternative investments kind of receded a little, as did real estate. Still, nobody loves bonds. They just continue to be shunned by investors. And we know that the short bond trade is pretty hot. Are you
Yeah.
looking at any sort of a squeeze in bonds, Brett, or is there anything that you'd want to do on that side of the bill?
That's another one where I feel like there's been times where I've been involved in something like TLT. I feel like there's other areas where I have more of an edge right now, and I tend to do that in my trading and investing. I feel like I figure out where I feel like I have an edge, and I try to really limit my activity to those areas. And right now, there's been times when I've definitely had an edge in the bond market, and right now I do not. Everybody wants the same position that I wanted, and it makes me feel uncomfortable to be part of a crowd, especially when it's a lot of small speculators. So it's possible to go the other way, but I've still been looking for 2% plus.
Yeah, yeah. So, all right, just keeping an eye out here too on the markets as we go along. A little bit of a bounce in Bitcoin actually, as we're talking here, Brett. So, okay, so
Which could be a risk on indicator.
yeah, yeah, yeah. Watching that the GBTC. Haven't gotten many alerts to the upside today, Brett. So that's
No.
pretty impressive. All right. So again, just kind of looking at where we stand with tech. We've discussed this, but long tech stocks remains the most crowded trade. Short treasuries, the second most. Short China stocks. Tied with short treasuries there, then long ESG, as you were just talking about, and long Bitcoin. So I guess China stocks. We've talked a little bit about each one of these topics. Anything that you're thinking of in the beatdown that we've seen in China? Is this an area where you would see as an investment potential,
China?
or yeah, or do you see some of the aspects with the Communist Party and how they're treating some of the businesses? Would that
Yes.
keep you? Would that keep you on the sidelines there?
Yeah, pretty much. I mean,
Uh,
how
what
can you
about
have?
for a bounce?
Well, so there may be some trading opportunities there, but beyond that, I mean, what the rules are completely unclear.
Yeah, yeah, and that would keep you to the sidelines on it from a long term basis.
Yeah, I mean, I don't know. Like there, I just think in terms of where I have an edge. When you don't know what the rules of the game are, it's impossible to have an edge. It's just guesswork. I mean, it may
Yeah.
be a good guess, and you could pretend that you knew something, but I can't certainly say as an analyst in that capacity, talking to other people, that I have any insight into how the Communist Party there is going to decide to change the rules. It looks like they've become, more aggressive on a trend that's a long-term trend.
Right. Okay. Economic expectations, Brett. I'm assuming that we're going to see some of these overweight equity performances dive down a little bit. This is one thing that we've been talking about the last few times we got together here for the Sentiment and Flow show. This drop off in overall sentiment for expectations for a stronger economy, and it wasn't matched up
Mhm.
with the weighting in the equities. I'm assuming that we're going to see a steep drop off in this given the selling. But what would you be looking for in this chart moving forward the next couple of months?
Well, the lighter blue line is always leading the darker blue line. You can look just in the history of this chart. Look at the first move up. There would be a gap that then gets filled over and over again. So I suppose we're going to be looking for that move in allocations to drop.
All right. Now, here's one that would probably um, surprise people. Now, Brett, you talk all the time about you'd like to see a little bit more in terms of the context behind some of these questions.
Yeah.
But the CPI expectations obviously fallen off a bit of a cliff here. Now, my assumption is that this is people being asked this question in the context of a year over year, which obviously we got some tough comps given the pops that we saw in 2021. Is that how you're kind of viewing this chart, or does anything stick out to you when you're looking at this that you're going to be looking at for in terms of inflation data moving forward?
No, I mean, both. There is, yeah, the year-over-year comparisons are going to become an issue, and at the same time, we're just about past the pandemic. And again, that allows supply chains to rebuild. And if you're looking at what we don't know is this about the next CPI data point, or is this about the next year of inflation?
Right.
Right. And if
Uh,
it's the next year of inflation, which I kind of suspect it is, like over the next 12 months, will CPI be higher or lower than it is now on a year-over-year change basis? And I guess the easy bet would be that it will be lower a year from now than it is now. And a big factor being we rebuild global supply chains in a way that's effective and easy.
I did find the PMIs this morning interesting, Brett, where they talked a lot about the PPI, which is, of course, the producer part of it, which, you could use that as ground zero, if you will. Obviously, if companies are getting higher costs, then at some point they're going to move it on to the consumer and it floats into the CPI. That's generally the direction inflation goes. So, are you encouraged to see some of the PPI commentary out of Germany? And now I did not get a chance to double check the U.S. this morning on that commentary, but I thought that could be at least a little bit of an idea of this temperature breaking on the inflation side.
Yeah, I mean, it certainly, we're going to start seeing, I would imagine, that story start to come through.
Okay. Moving on, rate hike expectations. Now we got Powell coming out here and Powell and Company coming out in 2 days. And we've seen people move firmly into the three rate hike camp. Four rate hikes actually might even be at this point, Brett, the baseline. I don't know if we've gotten that high. I saw Goldman came out with some comments about it. And the Fed funds futures are starting to get closer to pricing in
You
for
see Jamie Dimon,
yeah, what 2 weeks ago he said
six
that
to
he
seven.
expect for this year.
Yeah,
Did he say? I
six
know
to
I know
seven.
he said he expected four in the conference call, so he's raised
Oh, I
that
thought he
to
said
six
six
to
to
seven.
seven this year. I was assuming that he's doing double twice.
Yeah, no, I definitely saw him say four when I was coming to
Okay,
JP Morgan. Now it's possible he came out and updated that, but I did not notice that.
okay. I'll go back and check. He said it maybe unless he meant for the entire cycle, but that wouldn't.
I'm guessing for the 2-year cycle
Okay.
was the context there. And again, I could be wrong, but I can't imagine he'd be yelling fire in the movie theater here with the 6 to 7 call. Four, he definitely said that was in his prepared remarks and everything.
You think
Um,
we get a double in March?
I do at this point. I think if we see I think he's going to lay the table for it with the idea of a little bit of a kitchen sink
Hmm.
Fed, if you
Right.
will.
Right.
He's already kind of got the markets leaning more into their favor. He's obviously pretty concerned about inflation at this point. I don't think that he wants to be aggressively raising right around the midterms. I think that he's going to want to get those rate hikes in early, let them take effect, let the impact of the economy happen earlier in the cycle so it doesn't look like the Fed is having that much influence on those midterms. So, yeah, I'm of the mindset that if they are that concerned about inflation and if he strikes a hawkish tone on Wednesday, that they're going to do 50 basis points.
Right.
Do you think that that's far off?
No, no, I completely agree.
What are you thinking is he's going to be doing on Wednesday in terms of just overall tone? Now, obviously, we got 2 days of trading ahead of time. I'm thinking that we see a bit of a short squeeze uh, tomorrow around people thinking that perhaps he is going to strike a more dovish tone. I don't think that's going to be the case. I think that they want to take advantage of this to push that hawkish, I don't want to call it agenda, but what's your early expectations for the Fed?
I think that he's going to say nice things about the long-term future picture, and that
Correct.
they that the cycle's great, everything's are going great. We're just going to go ahead and adjust interest rates higher because economic growth is doing so well. We've also got some supply chain situations that are going to resolve themselves later in the year. We need to normalize policy.
Yeah, and I agree. I think that he wants to make it clear that this is a bullish rate hike, right? It's not
Yeah,
just
yeah,
about stamping out inflation, and that's kind of going to be the key context in order to avoid a much bigger sell-off. Hey, we're raising rates. Inflation's certainly there. We think Omicron will settle, and we're seeing signs that that's working through, but overall demand remains strong, and we need to raise rates to get in line with a strong economy that we're seeing.
right.
I think that's going to be the basis of the story. So we'll be interested to see how the market reacts. But yeah, I do think that a two rate hike March is definitely on the table now. All right, moving along. Another look at inflation expectations there. We kind of already discussed that. Second look there. Risk appetite. Brett, how do you view this? Obviously, a lot of people have pulled back on the risk side of things. Do you have any thoughts on this particular chart?
No, I mean it's pulling back toward midpoint. We're going to see it a lot lower um,
Yeah.
as this process plays out.
Is there any sort of extremes that you'd like to see, down around that -40, -30 that would warm you up a little bit more?
Yeah, I mean, you tend to overshoot, right? So if you look at the whole cycle, you can see this last leg overshot everything. I would think that if we were in a reaction to that, that's certainly feels like of the magnitude that we're watching. I would think you're going to see this, yeah, maybe all the way back down in the -30 area.
Okay. All right. Well, that is going to do it from our end over here in terms of running through the slides. Brett, the key item for us is keeping an eye out on these markets and look for any sort of extremes. We're seeing some early signs of that, but we haven't seen anything that I think is completely raising the red flag to suggest that this selling is completely done. But what are some of the things that you'll be looking at for over the next couple of weeks to try to get a better sense of where we stand in this cycle?
Well, so to be clear, like I think we may be finishing a first leg today, but I don't think that it's the only leg. It's not like you're just going to buy into if you catch this low, it's straight back to the highs. I think that's the big difference. But we're in things are pretty bloody today, so things move in different time frames, and you're getting this initial shock, price shock to the downside of volatility, and I think we can see a pretty powerful bounce out of it, but we'll probably be back here.
Yeah, and it just kind of also lines up into what we generally see with sell-offs, right? They just seem to be a lot more aggressive the last 10 years. It's probably just with the way information's being able to be passed around, or groupthink, whatever it might
Sure,
be. But this just
it's
kind of
easier to
falls.
herd.
Yeah, it's easier to herd, and I think it really makes the selling look all that much more aggressive just because you see it happen in a 2-3 week span, and that's
Right.
certainly what we're getting right now. So, all right. Well, we will be back in a few weeks to take another look uh, at where we stand in the markets. Obviously, in the sentiment and flow show, we'll be keeping an eye out on some of the data points. If there's any updates necessary, certainly the VIX and put call ratios are two that we'll probably be commenting on a daily basis. But Brett, is there anything else you wanted to add before we leave for the day here?
No, I think we were pretty comprehensive.
Okay. As per usual, if anybody has any questions for us, feel free to write into either Brett or myself. We'd be happy to answer them. We taped this obviously for everybody to be able to go back through and listen to it at your leisure. But a lot of good information in here. If there's questions on any of the data points that we provided, please feel free again to write in. But Thanks for joining us. And Brett, we'll talk to you shortly. And good luck trading out there in the futures.
All right, sounds good, Gav. Take care.
All right, talk to you soon.
Yep.